Amazon and Baba, two huge e-commerce businesses. They're ginormous. And guys, I want you to remember, these are prime examples of how stocks don't stay incredible forever. Amazon has been the darling for the last 15 years. It's been incredible. And now all of a sudden, people are worried about Amazon. Baba was the China darling. And then all of a sudden, everybody hated China. And the stock has plummeted 70, 80%. Remember, I was not buying Baba at $310, $320 a share. I started buying it sub 200. And I've been buying it all the way down. Please don't just mimic me. But let's go look at our 8 pillars on Amazon and Baba. Now, Amazon is one of the companies I was horribly wrong about when valuing them years ago because I didn't think they could do the revenue growth that they actually ended up doing. It was unbelievable. I did not see that. Okay, I was wrong on them. I'm fine with that. So let's go evaluate Amazon now. One thing to keep in mind, 52-week high was 188, and just last week they hit 98 because of the fact that they absolutely missed on their revenue and profit projections. And they said they're going to break even in the final quarter of the year, including Christmas. Break effing even. But Amazon is still a great company, but the profit margin's a little lacking. Guys, look at over here. The 5-year profit margin on Amazon is 4.2, and last year's profit margin was 2.3%. Selling goods is not lucrative for them. They're still working on it, and it'll probably become more and more profitable. But they spend a lot of money on their shipping. Look at their free cash flow. It's down a lot. They're investing a lot in the business. So this is a long-term play on Amazon. This is not something you're buying on today's numbers. Because on today's numbers, it's absolute garbage. It's absolute garbage. You got to buy it based on long-term, okay? It's a potential growth stock, which is kind of interesting considering they do $500 billion in revenue in the last year. But you got to value it based on the future. And I'm okay with that. So let's look at the 8 pillars right now. Oh boy. Well then, now this looks like what a growth company would have. A growth company would have a lot of X's. I mean, look at, I don't even look at this. Like to me, I'm looking at going, great. I don't care about the 8 pillars here. This is not what I'm focused on Amazon. I'm focused on what does it mean about the future? That's just like Palantir. When I did a Palantir video, it's about the future. I'm okay with companies losing money as long as I can see a pathway to profitability. And with Amazon, they've had profit. Okay, let's go look at the analyst estimates. Analysts expect them to make 10 cents a share this year. Sick. But in the next 4 or 5 years, it's going to jump to $24 a share. Guys, if that's happening, if you believe this, you're crazy not to buy Amazon today. Because a 15 multiple makes this a $360 stock. $360. You're buying it at $100 today. If you believe this, in 4 or 5 years, Amazon should be well over $300 a share. The question is it going to happen? I don't know. Let's look at their revenue. Revenue growth. It's going to hit almost $1 trillion in 4 or 5 years from 530 this year. That's incredible, guys. That's an incredible number. And there's not a small number of analysts here. There's 28 and 29 analysts here in year 4 and 5. That's big numbers. That's our data feed. All right, so let's go look at our stock analyzer tool. Now, guys, whenever I look at a company, I ask 3 questions. 1, do I think the company will be around in 10 years? If the answer is yes, my next question is, do I think their revenue and profit will be higher 10 years ago than it is today? If the answer is yes to that, I go to the next question. Can I buy it for a reasonable price today that accounts for the things, the unknowns, gives me ample margin of safety where I can get a good return on my money? That's what we use a stock analyzer for. Are we close to a number? So I recommend that you rewatch the Amazon stock analyzer tool and the Baba one. Just rewind it and watch it because I want you to hear the things that I'm saying when I'm looking at this. Because I'm going to speak a little bit faster probably because I've done this 8 billion times. I use this software every single day, 5 times a day to analyze my companies. So revenue growth. Analyst estimates for the next 5 years were low double digits. So I'm going to go with 4, 9, and 14% for the next 10 years. Guys, keep in mind, at 14% for 10 years, what does that take us to? 1.14 to the power of 10 times 500. It takes us to $1.8 trillion in revenue in 10 years. That seems a little bit of a stretch, but then again, I would have never thought Amazon was going to do $500 billion in 2022. So crazier things have happened. Profit margin. Now, I do think their profit margin will get better over time because of AWS and because of becoming more efficient in their shipping and their handling and their marketing. And they do a great job with advertising, selling advertising to people who sell on Amazon. We do it all the time with one of our businesses, Fit Active Sports. We spend a lot of money advertising our products on Amazon. So I'm actually going to go with 3, which is low, 5, and 7. 7 is double what they've done in the last 10 years, and I'm okay with that. But I'm going to go with 7 there. Same thing with a free cash flow. It should even out over long periods of time. Now, PE. Guys, this is an egregious PE, and it has to do with the fact that they're making such little profit. And they have no price of free cash flow because they ain't making free cash flow in the last year. Okay. So what's a reasonable price? The bigger the company gets, the lower PE you need to have. Growth is a big factor in PE. So I'm going to go here, and this is based on the growth it has at the end of 10 years. So when it's doing $1 trillion plus in revenue, how much growth does it have? I'm going to do 13, 15, and 17. 13, 15, and 17. Now, finally, for my desired annual return, I can get 9 or 10% from investing in the market. So my goal is to get a higher return with ample margin of safety. As I start lower, I've made more conservative assumptions here, so I don't need as high a desired annual return. As I make more aggressive assumptions, I need a higher desired return because I'm making higher assumptions that are less likely to happen. So I need a bigger margin of safety. So I'm going to go with 12, 15, and 18% return. Hit the analyze button. Boom. Guys, 20, I was on the low side, 70 on the high side, 40 in the middle. Guys, look at this. 70 is my high side number with 14% revenue growth. Yes, I have an 18% return, but let me make that just 12% and see what happens. It's barely even a buy today. That's how expensive the company is today. And I do think you need a higher, let's say you make it 12, 14, and 16%. It's still an expensive stock. Now, I have it on my watch list at 75. That doesn't mean I'm buying it at 75. What it means is, Paul, it's hit 75, start doing more research on it and see what you really want to pay for the company. And whatever price it is, start selling puts so you can get paid to wait. But the concern I have about Amazon is very, very low margin business. Now let's check out their Chinese counterpart, Alibaba. So let's go back to 8-pillar search, pick out Baba. How much money am I losing on Baba today? Okay, not a ton. Great. All-time high for Baba is $317.14. It's currently at $63 a share, 80% lower than its all-time high. And again, I repeat, I started buying at $183. So I'm still down a lot on my initial purchase. But overall, I've dollar costed average. I've dollar cost average along the way, and I love it. So what are the concerns about Alibaba? But before I get there, another disclosure. I sold my Alibaba position the other day as a tax loss harvest. I sold Alibaba because I had a lot of options income this year. I wrote off that Alibaba loss on my options income. I bought Baidu as my replacement stock just so it can mimic it. And in 30 days, I'm going to rebuy back my Baba position because I believe in Baba. Don't buy Baba just because I believe in it. The reason I'm okay with it is I'm okay if they get delisted from the US exchanges. Merrill Lynch has told me that if they get delisted, all that happens is I get my shares in Hong Kong. I'm okay with the Chinese government becoming a little more socialist because I still believe that people are going to go to the money. And the Chinese economy has seen the benefits of financial wealth. That's the fastest growing middle class in the world. A lot of companies, including Warren Buffett, have made a lot of investments in China. I'm confident that as the world gets larger and larger economically, there'll be more and more economic capitalistic economies that occur. And I'm okay with this. So that's my position. Doesn't necessarily mean your position. If you can't weather a stock going down 50% on you, don't buy it. Warren Buffett has said this all the time. If you can't stand a stock losing 50%, you should not own stocks. That is a very key part here. So I'm okay with my losses. I'm going to get some of it back on my tax loss harvest, but that's in full disclosure. So those are the issues with Baba going forward. The Chinese government and the delisting. I don't view them as big a risk as the market has taken out of it, but it very well could be the case. So look at what we have on Baba though. Much higher 5-year profit margin than Amazon. Last year's profit margin was very low. Gross margin, much higher than Amazon. Amazon was like 12%, 13%. This is 36%. They don't pay a dividend, but they have, let's see, what is their market cap right now? $169 billion. Much smaller than Amazon. Now let's go to the 8 pillars here. Not as bad as Amazon. Low PE, low price of free cash flow. They've issued a few extra shares and they've had net income drop. Okay, so that's a big deal. Let's look at that net income right here. Revenue's still up. Net income plummeted. 7, 8, 14, 24, 20, 5.5. Make sure other income expenses right there, minus 2.2. That doesn't count for the full thing, but that is an issue there. Their cash from operations have declined. They do have issues on that front. The question is, are they temporary issues or long-term issues? That's the question you need to ask yourself. So let's go look at analyst estimates. Now remember, this EPS is in Chinese currency. It's not in our currency. But what matters here is looking at the growth potential. They're basically they're going to increase their profit, according to analysts, by 80% over the next 5 years. Their revenue is going to go up another 50% over the next 5 years. If not, about 50% over the next 5 years. So there's still double-digit growth here and double-digit growth here. So for a company that's dying, supposedly, or can't be touched, it's got a lot of growth potential in there. So let's go right to our stock analyzer tool and make these assumptions. So again, rewatch this as you watch this video, because I want you to hear the thought process. I'm going to speak out loud as I go. Okay, so revenue growth. I'm going to go 3, 7, and 11% profit margin. I'm going to do 15, 19, and 23. Same with free cash flow. And then their free cash flow in the last 5 years was 25%, but I'm okay sticking with profit margin and free cash flow being the same. Now, PE, I'm going to go with, it's obviously a high PE because they have very low profit. I'm going to go with 14, 16, and 18. Actually, you know what? I'm going to do 13, 15, and 17. 13, 15, and 17. Desired return. I'm going to go higher here. I'm going to go 14, 17, and 20 because there are the social issues that have a problem, the political issues. Okay. Now, high side 145, low side 40, mid price 100. So even on the high side, it's lower than my startup purchase price before. I'm okay with that because I still think I'm being very conservative. I put in 20% returns here, 20%. And they're growing their iCloud business too. I put in 11%. It's a much smaller company in a much more growing market than Amazon. They're still in China, and China's economy is still growing like crazy with 1.6 billion people there. And their average income is still 80% lower than ours or something like that. So there's a lot more growth potential in that company. So remember, subscribe to this channel, but go back and rewatch the stock analyzer part because I want you to remember what an important part of the software it is. And it's important you understand that if you decide to go sign up for our software. Thank you very much for your time.